You can't go onto YouTube without someone telling you you need more sources of passive income. Many of which believe the way to do this is through
dividend investing,
dividend growth stock,
dividend stock,
a dividend paying stock,
dividend stock,
dividend investing. So is dividend investing the way to riches, and will investing this way allow you to quit your job and live off that dividend income? In this video, we find out if dividend investing is all it's cracked up to be. Hi, welcome to the channel. My name is Matt. I'm a UK-based independent financial planner, and here you will learn how to make smart decisions with your money so you can get the most out of your earnings. So, what is a dividend? Well, when a company makes a profit, it has three main options. It can keep this money to reinvest in the business, acquire other businesses, or reduce their debt. It can buy back its own shares from shareholders, which in turn improves the earnings per share. Or it can pay a portion of its profits to its shareholders. Now, this third option is where owners of the company share receive a dividend. So by owning this share, you receive cash in your account every year or even every quarter for doing absolutely nothing. Sounds like a no-brainer, right? Why wouldn't you want to own these dividend-paying shares? So let's have a look at an example. We have company A and you own one share in this company. The share price is £100, and at the end of the year, company A pays out a dividend of £10 per share. So you get your £10. Now that £10 you've received was previously in company A's cash reserves, but now it's in your pocket, meaning the company's cash reserves are down by £10. And because of this, the value of the share is likely to reduce as well. Now, prior to the payment, the share price is likely to increase at the announcement that a dividend will be paid, because investors know that they will receive a dividend if they purchase a share. However, at the ex-dividend date, the cut-off date after which purchasing the shares will not make you eligible to receive the upcoming dividend, the share price is likely to then reduce as new investors are unwilling to pay this premium. This, combined with all of the stock market fluctuations going on, can make it difficult to notice these movements. But effectively, as the company's cash reserves are down due to the dividend payment, the company's share price reduces too. Another factor to consider is taxes. Depending on where your income and the tax rules where you live, these dividends may be subject to tax. In the UK, if your investment is within an ISA, then you will not pay tax on dividend income. If it's outside an ISA, you currently have £2,000 tax-free dividend allowance. And then any dividends over this are subject to these rates. So it's really important to be aware of how or if your dividend income is taxed, as what you think you're receiving as a dividend may be less than you expected. Another point people overlook is that relying on dividends as income is often risky, as they're not guaranteed. In 2020, 500 companies listed on the London Stock Exchange either cut, cancelled or suspended their dividend payments. We saw the likes of BP cut their dividend payment by half, Shell cut their first quarter dividend by 66%, and UK banks such as HSBC, Barclays, Lloyds made no dividend payment in 2020. Even more recently, Intel cut their dividend by 65% earlier this year in 2023. A paper published in 2022 by Brower, Hackerthal and Hanspel looked at the data behind customer transactions at a large German bank. They surveyed these customers as well to understand their saving and spending behaviour. They found that more than 60% of investors view dividends as expected source of income. Market changes or world events can lead to companies being forced to cut their dividends. And if you're relying on them for income for your lifestyle, then you need to be prepared if a payment doesn't come through for whatever reason. Another reason to be cautious of solely focused on dividend investments is you're concentrating on one part of the market. Many companies that consistently pay dividends are well-established, mature firms that have sufficient cash reserves and don't need to reinvest a large portion of their profits back into growing the company. However, if you're only looking for dividend paying shares or dividend focused funds, then you could be missing out on more growth style investments. These could be companies who are looking to expand and therefore want to use the profits they've accumulated on growing the company and therefore growing the share price. Even some of the biggest companies in the world don't pay dividends. Currently, 84 companies in the S&P 500 don't pay dividends, and these include Facebook, Alphabet and Netflix. So to conclude, I'm not anti-dividend stocks, and I think they're an important part of a well-diversified portfolio. But to solely focus on dividends, you could be opening yourself up to unnecessary risks. And as we know with investing, where it's appropriate to minimise risk, you should. If you're thinking about investing in a fund that holds dividend and growth stocks, then you need to check out my review of the VWRL ETF. To watch this video, click over here, and for more videos in the future, subscribe down below, and I'll see you in the next one.